I'm Spencer Cole, the Chief Investment Officer of VOX Royalty Corp. VOX is a high-growth, precious metals-focused mining, royalty and streaming company that's differentiated by intellectual property, a technical management team, and a very low geopolitical risk royalty portfolio.
Spencer, good to see you, mate. I think we caught up with you guys back at the beginning of October, and I just wanted to sort of end of year roundup, little chat. Saw the press release this morning where you're giving us an update on some of the operating partners. I mean, maybe start with that, and then I'll dive into some questions if I may.
Absolutely, Matt. It's a pleasure to be back. As you mentioned, we just announced another operator update where 4 of our key operating partners have put out some really exciting drilling results. One of them comes with a resource update, and the other 3 are basically foreshadowing resource updates that they expect to release to the market in the next few months. So most pleasing part of all this, Matt, is really just continuing to deliver on, I guess, what we've promised to investors in terms of just a huge volume of organic growth across our exploration properties, development properties, and producing royalty properties.
Right, and organic growth is important. Why? Just to remind people.
Well, organic growth is growth on capital that's already been invested, so as opposed to M&A driven growth that requires further capital. So this is cream on the top of dollars we've historically invested.
Right, and if I look at this this year, you've not been as busy of late as you once were. Are you now sort of honing in on how you need to deploy your capital? Because I've got to look at the share price, right? And the share price has been, you're up probably $1 on the year from the low to the high. It's been good, but it's been erratic. What do you put it down to? Is it the fact that people are not quite sure what you are yet?
Look, I think trading up 30% this year in a pretty choppy market conditions, when a number of our peers have been trading off, we're pleased, but we're not ecstatic with that outcome. We always think, there's more to go. In terms of the volatility, look, you see what's happening in markets. It's extremely choppy waters at the moment. So, we've seen a lot of erratic pressure on the stock throughout the year. But what really gives us confidence moving into 2022 is just the underlying fundamentals of the business, and the health and quality of the royalty portfolio has never been stronger. So yeah, while short-term volatility will probably persist into next year, the assets continue to perform as we expect. So we expect that should be tailwinds for the share price next year.
So we had a kind of session at the beginning of the year. We talked to lots of royalty companies, right? And I'm trying to help people understand why royalty should be part of their portfolio, because like even when we're talking about your press release today, you're giving an update, but it's not very exciting, right? It's very hard to get excited about royalties. And maybe that's fine. And maybe that's a specific type of investor that needs to think royalties are for me. It's a sort of slow and steady growth type of opportunity as part of my portfolio. What would you say to people as to why should a royalty be part of their investment portfolio?
Yeah, look, Matt, it's a good question, and like we get this question all the time. It's like, you put out these updates, and there's so many royalties, and what the hell does it all mean? Why should I care about these operator updates? And I've got a lot of sympathy because, look, your average investor, and which includes some of my family members, they'll say, why the hell? What the hell is important about this press release? But I think the takeaway from a lot of these updates is, properties that continuing to expand in size. So I'll give you one of these examples. So the Bowden Silver project, which we've included in this press release, the operator, it's already the largest primary silver project in all of Australia. The managing director was recently quoted on Bloomberg as saying he thinks the deposit could triple in size, and they've just commissioned an underground study which would add production on top of the proposed open pit. So, that's a good example where a royalty that we bought for $1 million last year, which has annual revenue potential of $2 to $3 million for 16 to 20 years, just continues to sort of look more and more attractive as the property gets drilled out and further studied.
Right. So stating the bleeding obvious, as Monty Python would say, is you invest $1 million. You think you're going to get $2 to $3 million bucks a year return off of that once it gets into production. So you need to believe it's going to get into production. You wouldn't invest your money otherwise, right? The tripling in size of the resource for you means just a much longer life of mine, a much longer annuity stream of cash return for you. And obviously then I guess all numbers associated with that $1 million looks stellar. It's as simple as that, right?
Yeah, it's bringing cash flow forward and increasing the size of the cash flow attributable to our royalty. So in that case, it's not only just the mine life that potentially extends. This underground would increase the production, in year 3+ onwards. So yeah, it's bringing forward cash to our investors quicker and larger, simplistically.
But the nightmare for you guys is you can't go out and sort of say that, can you? Because nothing's happened yet. A lot of things can fall over between now and then. So you can't go and overstate future revenues. You can only look forward so far.
Yeah, look, absolutely, Matt. We're not the type of management team to overpromise and underdeliver. We sort of pride ourselves on being able to set realistic and achievable guidance, particularly because we're not the ones operating these mining assets. So, we're sort of a derivative of these miners. So we don't have full 2020 vision. We have regular update calls with management, but, we're not in the driver's seat ultimately. So we have to couch all of our guidance and expectations through that sort of lens.
So you don't get any additional insight over and above what we, the public, do from those companies?
No, we do. It depends per royalty. Some royalty agreements have, quite extensive information access. Others have, less information access. And then, as just ordinary course, we have regular update calls with those management teams to make sure that the guidance we're providing to the market, is as accurate as possible.
It's really difficult because there's so much data that we as investors need to look at to be able to interpret what could be or is not necessarily going to be good for you, therefore good for us. Do you think that you guys should be allowed to present information differently, like a what if scenario? Because like I say, some companies really push it. You guys have talked to me in the past about discipline, right? And discipline sounds, it's probably fantastic, but again, sounds really boring. But it's probably the right way to be. It's sort of this steady state of building blocks, as it were. But there's no way of kind of reconciling this as retail family office investors into a number each month, other than waiting for your annual guidance.
Yeah, look, I think one thing investors can get really excited about is if you look at a side-by-side comparison, and in our recent investor presentation, we introduced a new slide which looked at, owning the equity of a miner versus owning a royalty. And we gave a case study looking at an investment that Franco-Nevada made 10 years ago in a gold mine in Ghana. And it's night and day, the leverage and the torque you get from the royalty. And with VOX, obviously, the volume of discoveries that we're having in our portfolio is, versus us buying a single junior explorer, it's night and day. So the upside is completely, a multiple at, a fraction of the risk profile. So for us, seeing all these new discoveries and the projects moving forward on a monthly basis, that's what excites us. Maybe it's because we're weird royalty nerds, but hopefully that excites some of our investors as well.
Can we pull up that slide?
Yeah, sure, absolutely. So this just looks at a royalty deal that Franco did back in June of 2011, where they bought a 1.5% revenue royalty on Perseus's Edikan mine for $35 million. And what we've done simplistically here, Matt, is just looked at, on a like-for-like basis, if instead of buying a $35 million royalty, if they had bought $35 million worth of Perseus's stock. And so the two things this really highlights, one is the fact that royalties aren't diluted, and secondly, just the huge revenue multiplier and leverage you get from a royalty. So Franco-Nevada has been undiluted. They still hold 1.5% of revenue over this mine. They've received over $40 million US in royalty revenue, whereas an equity investor with that same position, the stock's obviously traded down quite substantially, and then they would have been diluted from 3% of the company to 1.1%. And fairly de minimis dividend income. So we get this question often from investors like, why don't I just buy the miners? And I guess on a 10-year horizon, this is an interesting comparison where you can see the real numbers of how you would have fared investing in the equity of the miner versus a royalty on the miner's flagship asset.
Interesting. But I guess there's lots of different scenarios there where perhaps the share price doesn't fall off the side of a cliff, and there are going to be companies which maybe
no, for sure. This is just one example, but these are real numbers. So this is and I think the dilution you see here is quite representative of a lot of operators and developers that obviously need to raise considerable equity to bring projects into production.
Okay. I appreciate that. We should probably we'll put a link to the presentation below in the description below. But so looking forward to 2022, what can we expect? Because like I say, you were not as active as you once were. Is that because things are getting competitive out there and you don't want to overpay, or the fact there's just not that many deals coming up at the moment?
No, we have been quietly adding new royalties in the portfolio. We in the last couple of months, there's been a number of deals we were actively working on where the pricing we didn't see the rate of returns for our investors that we would have seen maybe 12 months ago. So we have continued to be very selective on new deals that we bring into the portfolio. I think it's fair to say, Matt, that 2021 will go down in history as the year of the royalty auction. It's probably been the most active year for investment bankers selling royalties and royalty portfolios. So against that backdrop, we've remained sort of quite cautious about how we've allocated capital. Also, as we're dealing with different royalty sellers, it's clear some their price expectations that have gone up north. We were speaking to a prospector in Western Australia the other day that has a really interesting base metal royalty, and they wanted 2x what we thought the royalty was worth. So that's not a trade we're going to make, even though it would have brought in considerable amount of revenue. So yeah, I think we have done less deals in the last 6 months, but I think investors can be satisfied that we've continued to be very careful with how we allocate their capital.
Right, and if I look at what's been going in the last 6 months, a lot of M&A, we've seen some really big numbers being thrown out there because the producers have been generating a lot of cash. So it's a cycle. They always do this. They seem to buy at the top of the market, or near the top of the market. How does that affect the royalty business? Because obviously those are some big numbers, producers coming together. They've kind of filled the hopper for a while. So the next cycle is people got to go and find projects to actually, for the next cycle coming through. So does that help or hinder your business in this current market, or can we expect to see a quiet period now for royalties and streaming more broadly?
Look, I think if you look at the history of the industry, it has been quite counter-cyclical. So the likes of Franco-Nevada, have often, frankly, sat on their hands during frothy parts of the cycle, and then when the trough comes, they've been hugely active, particularly helping larger mining companies to recapitalize their balance sheets, and getting access to some world-class assets. So we sort of, I guess, broadly see that counter-cyclicality continuing. I think we will continue to print deals over the coming months and quarters, but they will be quite selective, and deals where the counterparty has value expectations that we can meet for our investors. So I think in terms of when we see large scale M&A, like whether it's Kinross buying Great Bear or some of the other large cap M&A, we think it's hugely positive for the sector, because it obviously means that there's a large amount of balance sheet that's still committed to the industry and committed to advancing these projects, with the obvious caveat being that we're in a cyclical industry, so we're continuing to have to be careful that we don't overreach for the wrong assets.
Yes. I think there's been a history of bad deals. Well, we talked about a few in our investment club as well. About obviously the Great Bear deal looks fantastic. I think it's a good project for Kinross for what they need to achieve. But in the past we've looked at instances where Kinross haven't quite got it right, and I think it's a salutary point that not all deals work out in the end. But and they I think in that case, so here's $7 billion written off. which is not nothing, So, look for you, but does that have an impact on the size of your deals? If all these big billion-dollar type deals are happening, does that mean that you'd be tempted to look at larger deals because you think the market's right at the moment, or is it this kind of disciplined approach to making sure that you're not overpaying and the deals will continue to be of a certain size? Which begs the question to me is this slow and steady growth for you? Because if you're doing lots of small deals, it takes a while to actually come through and build up, and maybe that's perhaps what people aren't getting or liking, quite frankly.
Look, I think we don't have a sort of arbitrary number in terms of minimum deal size. If I give one example, like we did a deal, we didn't actually press release a couple of months ago. It was on a gold royalty in Western Australia. We paid, it's almost embarrassing to admit it, but we paid $50,000 for the royalty. But based on the resource and the fact that it's a mine that's being restarted, we think there's revenue potential there of $3 to $4 million. Assuming subject to the final studies that come out by the operator. But that type of multiplier effect on return on capital, that's exactly in our sweet spot. Now, if we arbitrarily said we won't touch any deal below 100K, that's bad business. So I think it's a long-winded way of saying we're going to continue. Our North Star continues to be return on invested capital, and if that comes in the form of larger deals, great. Or if it's continuing to hoover up these, hugely value accretive but smaller ticket size deals, we'll probably do a balance of those types of transactions. We have had a number of really interesting royalties under option this year, Matt, that were, I would say sort of transformational sized royalties, but where, on further confirmatory DD or based on the return profile, we couldn't see the same volume of value for our investors. So we walked away from a few deals. And then in some other cases, we had ROFRs that the mining companies exercised, which, that continues to be our greatest source of competition because we price deals, aggressively in our favor. Often the mining companies, if they do have a ROFR, they'll happily exercise it and buy the royalty back. So that is, all kinds of frustrating, I can assure you.
Yeah, I bet it is. And I can understand what you say. Oh, I fall in love with the multiple. Brilliant, 50,000 in and maybe 3-4 million back. That's a nice multiple. But 3-4 million is small beer, right? It's nothing. It's not ambitious. And I think if I look at some of your competitors or your peers, not competitors is a moot term, your peers, they're talking big and they're thinking big, and people are rewarding them for that. I mean, so I appreciate you say you're in the conversation. You are making the choice not to go down and pay big bucks for things which you think are overpriced. I get that. But at the same time, you've got to show some sort of scale to this thing. Otherwise, you're going to have to do hundreds of deals to be meaningful in size and scope and ambition.
Yeah, look, I think all else being equal, it'd be much easier to buy big portfolios of royalties for big splashy prices, and then we could do one deal a year and then, rest on our laurels for the rest of the year. But I guess, we're not arbitrarily focused on just revenue, just growing revenue. There's some royalty companies out there that I think they want to build an empire and they want to grow revenue at all costs. Now, there's a lot of royalty revenue you can buy out there, Matt. But whether it has an acceptable rate of return on it, completely separate question. Our North Star has been return on invested capital. So, if that means that we have to do more deals to hoover up more disparate royalties from weird and wonderful royalty holders, if we think that's got a superior long-term rate of return attached to it for investors, that's what gets us excited.
But tell us why that's important. Tell me why that. Well, we should. I want to, because tell me why it's important. A rate of return, I get it. Okay, so if you're saying I'm going to do a big expensive purchase, but the rate of return is a tenth of what you guys could get, but it still equals $10 million. I'm like, okay, $10 million is a lot of money. The rate of return sucks, but at least there's some margin being generated there. So when you say people do it at all costs, it's like sometimes it's the right thing to do, isn't it?
Yeah, I think one interesting metric we've looked at recently, which we also included in our recent presentation, Matt, was price to book value. So it's basically a function of for all the royalty companies in the industry, how much has the market rewarded them for each dollar of capital they've invested? Now, if you take us at one bookend, we've invested $30 million to create $140 million of market value. So, we're right up there with Franco-Nevada in terms of the efficiency of how much, multiplier we've added to that capital. There's some other groups, that have been stretching to buy that revenue, as I suggested, that, are at closer to 1 times. So every dollar out the door has been given only $1 of market value. Now, that completely defeats the purpose of the multiplier effect on that the industry has delivered historically. That's not to say those companies won't be able to re-rate over time, but certainly the main thing we can control as management is how much we pay for the royalties. And so trying to keep that extremely, low relative to the market value of the royalties. If you look at how Franco-Nevada has outperformed the entire industry in the sector, it's by being disciplined on their upfront purchase price and then having those royalties re-rate in value. So that we're employing a very similar model to what has worked for Franco over the last 10 years.
Were they always worried about the efficiency? Was Franco-Nevada always worried about the efficiency? Or was there a moment where they said, at this time, because I think we've built enough credit, we've got enough money, we can be prepared to be slightly inefficient, but just get a big deal over the line, and it all kind of smooths itself out in a wash in terms of the way that people value the royalty sitting in a company. And then the point I'm making to you is, like, if you continue to try and do the most efficient deals, it's going to be slow and painful growth, isn't it?
I don't think that's slow and painful, Matt. Look, I think we'll have to do more deals. That's pretty straightforward. But it means that we're going to have more diamonds in the rough, so to speak, that I think we'll bring into the portfolio. Because every time we get a deal that we think we could make 20 to 50x our money, we might have a few others that have lower rates of return, but the portfolio returns that we're targeting, we think are quite compelling. So it's more painful for us. You're absolutely right, because we're going to do more deals. But, that's what investors pay us to do, is try and chase value and deliver that value. So,
okay. Talk to me about share buybacks. You've done a little bit of share buybacking. That's right, friends. Buying some shares back.
Yep.
Recently, what's the point of that? Why bother?
So look, I think we've seen a really irrational discount on our stock for a few reasons, and selectively we've taken advantage of that significant discount by going into the market and buying back our stock. So for every dollar of capital that we deploy, we'll look at what is the highest rate of return, and sometimes that's buying new royalties, sometimes it's buying back our own stock. So we just see it as a prudent way of allocating capital and taking advantage when the market is applying, an irrational discount to our share price. So it's a pretty boring answer, Matt, but it really is just a general ordinary course capital allocation basics, really.
How much money have you got available to you in whatever form for future?
We've got about $9 million of working capital on the balance sheet.
Is that enough?
Yeah, I mean, I think. Look, it's certainly not a war chest, but I think having that amount of money keeps us focused on doing the right deals, not doing all deals, so to speak. I think it's bad practice to be sitting on a war chest of cash.
And does that make you defensible if someone comes in? Because there's going to be consolidation in this space. Does it make you defensible?
Yeah, look, I think the consolidation theme in the industry continues, Matt, and we'd be shocked if it didn't continue into next year. I think our cash balance is right-sized for now. We've got no plans on raising further equity. So, and if someone wants to come along and knock on our door and do a deal and acquire VOX at, a meaningful premium that we think reflects fair value, we're not kingdom builders. We're here to maximize shareholder value. So we're open to approaches and offers. And if someone wants to knock on our door tomorrow, we'll happily entertain that conversation. But we're not going to give the farm away without paying the right price.
Okay, and just remind us of the guidance for next year, if you wouldn't mind, just in terms of revenue, certainly.
So we haven't provided formal revenue guidance. We will be providing it early next year. Brokers have us doing so this year. Our guidance was $4 to $5 million in top line revenue, which we're on track well on track for. Next year, brokers have us doing about $6 to $8 million of top line revenue. And then the following year, brokers have us doing between sort of 8 to 10. And so we'll provide formal management revenue guidance early next year. But I guess those broker estimates are all that's out there in the public market right now.
Okay, Spencer, look, appreciate your time today. We will be following you closely next year. Well done on this year, and thanks for the roundup.
Thanks for your time, Matt. We look forward to having an exciting year, more exciting year next year.